my name is Thomas O'Regan and I'm a professional property investor here in Australia. Now, I just wanted to talk about what is LVR when it comes to banking and borrowing and getting a loan for a property, whether it's a home or investment property, doesn't matter. What LVR stands for is loan to value ratio. Loan to value ratio. So for example, if you buy a home or if you buy a property, doesn't matter what it is, if you buy $1 million property and the property you're putting in $100,000 as the deposit, that means you're getting $900,000 loan. And if you're getting a $900,000 loan, that means you're getting a 90% LVR on the property. Now, why is this important? Let me just do another example first. So again, just to drill it in, if you're buying a property for $1 million and you put in $200,000, that's an 80% LVR. It means the bank's putting in 80%, you're putting in 20%. You have an 80% loan to value ratio. You have put in 20% deposit, $200,000. Now, why is this important? So basically, the banks, the higher your LVR is, the more risky you look to the lender. Now, what does that mean? So basically, if the lender looks at you and says, this person isn't putting in much money, this loan is a high risk for us as the bank because the likelihood of this deal going bad for us is high. So what do they do about that? They charge a higher fee, they charge a higher interest rate for doing the deal or proceeding in that relationship, I guess you could call it. Now, what happens if your LVR is lower? The bank, for example, if you buy a property and you're like, hey, I want to buy a property for $1 million, but I have 500 grand. They're like, hey, that's amazing. No worries. We can lend you 500 grand. Low risk, no risk for us at all. You know, the property value could halve, and you know there'd still be plenty of money for us to get our money back anyway. So basically, that is a low risk. What does that come with? That comes with better interest rates and better fees. Okay, so that's the importance of LVR. Now, most people, to get into the property market, you have to use the highest LVR you possibly can, because it's far better to get into a property, to buy a property now rather than wait 5-10 years to make the savings to buy the property with a lower LVR. So basically, you start investing with a high LVR, and by the end of it, you are investing with a low LVR because your properties are growing in value and you're using your properties to buy more properties. And as time goes on, the property value increases and the debt stays the same, so your LVR goes lower. Hopefully that was helpful. See you guys next time. Bye.